You're probably sick of everyone telling you to start investing in the stock market. Sure, you know it's important, but it's not like they teach you this stuff in school, right? And as much as you want to grow your money for the future, you also don't want to run in blindly and make some colossal money erasing mistake. To be honest, investing is really confusing when you first get started. Well, worry no longer, because in this video, I'm going to give you the foundational knowledge you need to understand what the stock market is and how it all works. Are you ready? Let's go! Let's start with defining the stock market. The term stock market refers to several exchanges in which shares of publicly held companies are bought and sold. Such financial activities are conducted through formal exchanges and via over-the-counter or OTC marketplaces that operate under a defined set of regulations. Both stock market and stock exchange are often used interchangeably. Traders in the stock market buy or sell shares on one or more of the stock exchanges that are part of the overall stock market. The first stock exchange was founded in Amsterdam in 1602, but it wasn't until 1720 that it became an official entity with its own rules, regulations, and governing body. The London Stock Exchange was founded in 1801 with the intention of serving as a clearinghouse for share transactions between member firms, thereby helping to reduce transaction costs for all participants. Today, there are several hundred international stock exchanges throughout the world. So what exactly are stocks? And do they make people money? Stocks are different from other investments. They are a share of ownership in a company, which means that you can own part of the company's profits. The value of your shares is determined by how much you pay and how much profit the company makes. So it's important to be careful about what you invest in. Companies that are profitable are more likely to grow and make more money, but there's also a risk that they will lose money or go bankrupt. Stocks can also be risky because they can go down as well as up. You might want to buy into a company that is doing well because it looks like it will continue making money. But if its stock price goes down too low, then you'll lose all your money and have nothing left. To avoid this problem, you should only invest in companies with strong track records and a long history of success. Okay, so probably all of that was pretty easy to follow. But now, we are going to get into some of the details. You may not be aware that there are 4 primary types of stocks. Number 1 is common stocks. This is the most common type of stock, and they represent ownership of a company's assets. They're issued by publicly traded companies, but you can't buy them in person. You have to buy them through an intermediary, like a broker or a bank. Second are preferred shares. It's just like common stocks, except that they have a higher dividend yield than other types of shares. You can buy preferred shares directly from the issuer or from a broker or bank. Third, bond stocks represent a debt owned by companies and can be purchased by investors looking for safe investments that pay out regular interest payments. The fourth and last type of stock is equity stocks. These include both common and preferred shares as well as other types of instruments, like warrants and convertible securities that allow an investor to purchase stock at a specific price within a certain period of time, called a conversion rate. So what's next? Well, let's talk about the steps to get started on investing. The first step is to identify your risk of tolerance. When you're investing, it's crucial to identify your risk tolerance. What's the chance that you stand to lose money while investing? Stocks are categorized in various ways, such as large capitalization stocks, small cap stocks, aggressive growth stocks, and value stocks. They all have different levels of risk. Once you determine your risk tolerance, you can set your investment sights on the stocks that complement it. But first, let's talk about what risk really means. It's not just about the likelihood of losing money, it's also about how much money is at stake when things go wrong. Are you willing to lose $1,000 or $50,000? Once you know your tolerance for risk, you'll be able to pick up investments that are tailored to your needs as an investor. You should also determine your investment goals. When opening a brokerage account, an online broker such as Charles Schwab or Fidelity will ask you about your investment goals, as well as the aforementioned level of risk that you're willing to take. First and foremost, it's important to consider how much time and money you have available for investing. If you have enough money to invest in different stock funds every year, that's great. But if not, consider investing in 1 or 2 funds with larger allocations to stocks or bonds. You can allocate more than 100% of your investments into stocks, if that's what makes sense for your situation. After determining how much time and money you have available for investing, you should think about how much risk you are willing to take on by investing in stocks versus bonds. If you want peace of mind knowing that your investment is less volatile than others, then go for bonds. If not, then choose between stocks and bonds accordingly. The third step is to determine your investing style. Investing is a lot like running, but with less sweat and more money. If you want to get started on the right foot, it's important to determine your investing style. Some investors want to take an active hand in managing their investments, while others prefer to set it and forget it. Your preference may change, but decide on an approach to get started. It might be helpful for you to identify your main goals for investing so that you can focus on those things first. For example, if you are saving for retirement, then maybe you'll want to invest your money in a low-risk account that allows quick access when needed. On the other hand, if your goal is to build wealth over time and pass down an inheritance for your children or grandchildren, then maybe you should consider investing in bonds instead of stocks, which tend to fluctuate. Or maybe you'd like both. You just won't know unless you ask. The last thing you want to do is invest in the wrong account. The right account can help you grow your money and start to build a nest egg for the future. It's also important to know what a retirement plan will cost you if you don't have one at work. Retirement plans at work are available in many different forms, including 401ks, 403bs, 457 plans, and SEP plans. If your employer offers an option to invest in these funds, you may be able to take advantage of this opportunity. You should also check with your employer about whether or not it offers its own company stock or investment funds that are managed by third-party companies. If you don't have access to a retirement plan through work, then consider investing in individual stocks or mutual funds through a brokerage account. You'll need to make sure that these investments are appropriate for your situation and risk tolerance level before making any decisions about where to put your money. While there are many different types of accounts available for investing your money, we recommend starting with an automatic savings plan, or ASP. Sure, investing has some risks involved, and it requires a bit of due diligence and study. But if you can get through that hurdle, the potential rewards are pretty amazing. It's up to you if you're gonna let your fear stop you from receiving the financial freedom that you're wishing for. Don't give up easily. Instead, make sure that you follow your heart and do what makes sense to you at this point in time. You'll be able to find a way out of your financial problems, if only you put your mind to it. Believe it or not, there's one huge investing vehicle that I didn't get into details about on this vehicle, but it's probably one of the biggest superpowers for most investors. It is what Warren Buffett advises to use, and I have this video that gets into all the details. Click on that thumbnail, and I'll see you there!